Good afternoon. Thank you for coming to the National Press Club today. And for those of you joining us remotely, thank you for viewing our program through the live stream. My name is Milo Cividanis, and I'm a partner in the regulatory group in the Washington, D.C. office of the Venable law firm. Our program today features a presentation by my partner, John Bowman, regarding his paper, Credit Scoring in the 21st Century. John, before we get to your presentation and some questions that I have about it, can you tell us a little bit about your government service, including your 4 years, or your years as the last director of the Office of Thrift Supervision?
Absolutely. I retired from 30-plus years of government service, federal government service, in March of 2012. Took the month of April off as part of my retirement, and then joined Venable as a partner in May of that year. Prior to that, I had spent the bulk of my time split between two agencies. The Treasury Department, where I was the senior career attorney in charge of banking and finance issues. And then finally at the Office of Thrift Supervision, where I was its chief counsel, and as you mentioned, I was its last director for the 31 months of its, the last 31 months of its existence. I also served on the board of directors of the FDIC, board of directors of a group called the Neighbor Works of America organization, and in other capacities, including the Federal Financial Institutions Examination Committee and things like that. So I've got a pretty broad base of experience in terms of financial services, financing, and so on and so forth. So,
well, thanks.
Yep.
As I noted, your paper is titled Credit Scoring in the 21st Century. Tell us about it.
Well, before I do, let me just also suggest one thing, that in my role as a regulator, I had the ability and the experience, the exposure, if you will, to watch many, many things happen both in real time and after the fact, including one of the things that we'll talk about here today. But before I go forward, I sort of want to make a statement here. As an attorney, we have to be bound by the interests and concerns of full disclosure. So if you'll allow me this one transgression here. In the spirit of full disclosure, my law firm and I represent VantageScore Solutions and one of its three owners, Experian. VantageScore is one of the several credit score providers that would benefit from the position that I am recommending, namely removing from regulatory guidelines an endorsement of a particular third-party credit score provider. Since leaving the role of acting director of the OTS, and during the course of my private practice at Venable, I've had an opportunity to look into the critical role that credit scoring plays in our economy as a gatekeeper to affordable credit. While I and my law firm represent VantageScore, the views set out in my white paper and that I will discuss here today are reflective, I believe, of a sound public policy. So having said that, I'll start with in terms of the paper itself and the position we take there. 2008 was the start of a pretty significant event, not only in our economy, but in the world economy, as a variety of practices, a variety of incidents, products, etc., started to hit what some, many years before, predicted would be their inevitable demise. We're talking about mortgages, we're talking about other forms of credit, we're talking about positions assumed by various entities, words like too big to fail, systemic risk, operational risk, credit risk, and so on and so forth became a part of our everyday nomenclature. Washington Mutual, IndyMac, Citibank, Bank of America, Wachovia, other institutions and providers of credit in our economy, in this country, suffered, in some cases, catastrophic failures, which led to the demise. Many lived to see another day and continue to do quite well in terms of what they're doing. But throughout the course of that, Dodd-Frank became a part of our lexicon, especially here in Washington. Dodd-Frank was an attempt by the legislative branch and the executive branch to deal with and address many of the concerns that arose during the financial crisis. Additions to capital, additions to or concerns about loan quality, concerns about concentration risk, all things that perhaps as a regulator are much more common and accepted to me, and perhaps I'll take a minute to explain some of those things. Regulators, as a rule, and I think also coming out of the 2008 crisis, regulators abhor concentration. whether it's a credit quality, whether it's a geographic concentration, whether it's a particular product. And there are ways to deal with those concentrations. Capital is one way. Capital is king, which is basically the cushion between a loss and the deposit insurance fund and or the equity holders of a particular institution. We've seen lots of advances, lots of statements made in terms of Basel capital rules, increases there, Basel liquidity standards and things like that. And I'm getting a little bit technical, so slap me if I go too far, Milo, please, and let me sort of get back to the theme of the paper. As time has elapsed from the collapse of many of our institutions, both in the regulated world and what I will call the shadow banking world, as time has passed, as we've had a chance to reflect upon and review some of the events and some of the people and some of the situations that perhaps were the cause for some of those failures, regulators have adjusted their approach and continue to adjust their approach. Something I was used to doing, something I was used to being a part of, which was basically the examination of and the concern about different events, systems or otherwise, that could cause the next crisis, or at least be a contributor to the next crisis. Comptroller of the Currency, Tom Curry, coined a phrase called operational risk, which he applies to all of his institutions. And just so that I get it right, I'm going to read it, which is operational risk is defined as the risk of loss to earnings and capital from inadequate or failed internal processes, people, or systems, or from external events, and from the processes for measuring, monitoring, and controlling these exposures. A broad brush, granted, but a brush that had to be used and which is now being used by the regulators. But in the context of that operational risk and the concern about it, as a part of our representation of a particular entity, we came upon a situation where a particular legacy dominant credit score provider is the single entity, is the gatekeeper for the provision of a majority of the credit scores that are used in this country. Credit scores and their use have evolved, going back to the early 90s, when you started to see the commoditization of different kinds of products, whether they were mortgages, credit card receipts, utility bills, and so on and so forth. One of the ways to finance all of those activities was basically to package it, bundle it, sell interest in them. And one of the critical components of being able to do that is to come up with, as the market did, a standard set of rules or indices against which a prospective investor could measure their particular guesstimate of return, risk that they would be assuming, and so on and so forth. The credit score was a breakthrough. The credit score is now a critical part of, if not all credit decisions made in this country, probably 90 to 95% of them. The originator, and I would suggest, at least from my research, I won't say they were the inventor of it, but they were certainly the first party to put together the necessary capital systems, mathematical systems, algorithms, black boxes, whatever you want, to try and provide for a uniform credit score system, continues to enjoy that position today. For instance, the particular legacy credit score system is mandated in the seller servicer guidelines of Fannie Mae and Freddie Mac. As you probably know, almost all mortgages originated in this country today, if you're a lender, you want your mortgage to be a conforming mortgage. Conforming mortgages are determined by the seller servicer guidelines, which are generated by Freddie and Fannie. Those guidelines go somewhere north of 600 pages. They cover everything from insurance to different documentation. And they also mandate that the legacy credit score provider is the provider of the score that will be used to determine whether or not a particular mortgage will or will not be conforming. It's unclear exactly why that particular position continues to be held by the GSEs or by their regulator, the Federal Housing Finance Authority. But nevertheless, it is a fact of where we are today. In the meantime, as things have evolved from the 1990s to where we are today, there have been other parties who have come along who have invested the time, the money, the expertise, and the system knowledge to, in fact, provide additional, an alternative to the legacy provider, and to do so in a way that not only provides a level of predictability, which is really the critical point for lenders, the ability to predict repayment, but also to provide a level of inclusion in terms of credit scores, who gets a credit score, how those credit scores are compared to others. That's by way of background. A lengthy sentence, and I apologize for it, but our economy today, 70% of our economy is driven by consumer spending. The majority of consumer spending, directly or indirectly, is driven by credit. The ability to get credit, the ability to use credit, really determines the direction of our economy. The inability to get credit, if you're an individual or for some reason the credit score product is not available, can be catastrophic, not only to the individual themselves, it could deny them access to affordable credit. And we do have a thriving, and although we thought we had gotten rid of it, a strong shadow banking industry in this country today, basically because of the inability of some people to get affordable credit, to whether because they don't have a credit score or they don't have a job, the obligation to pay significantly higher interest rates than those who have credit scores to pay continues to fuel lots of investment and lots of interest in terms of people who are willing to provide that. But the critical point in that last statement I just made is the availability of credit scores. The availability or the ability of an individual to get a score which they can then use to get credit. With the events beginning back in 2007, 2008, in terms of credit, the incidence of bankruptcy, foreclosure, unavailability of credit, the Fed continues to carry out a fairly aggressive economic intervention program, basically trying to stimulate the availability and the use of credit. That continues to be frustrated by many things that are probably far more understandable to people other than I, but they don't seem to be working quite as well as we would like them to. But I think it's a prime example of the role that credit does play. I think what I would like to do, and I'll give you a couple of examples of the risk that comes from having a single entity, and only a single entity, serve as what I will call the gatekeeper, and we talk about in our paper as the gatekeeper of credit in this country. I'll posit a position, which is assuming that that particular entity, as a gatekeeper, was either unwilling or unable to provide a product, namely a score. The question would be, what would a lender do, including a lender that would want to provide a conforming loan to the GSEs? What would they do? What would they be able to do? What would they be unable to do if for some reason that particular score was not available? And the answer is that in all likelihood, they would not be able to make that loan. They would not be able to provide that level of credit to that particular individual. We're talking refinancing, we're talking about new mortgages, new homes, whatever else. And I'll give you an example that's not quite on point, but that's very close. During the most recent shutdown of the federal government, we started to hear stories about individuals, lenders, who were unable to verify employment, who were unable to verify tax returns, and as a result were unable to make a loan. So there were, more likely than not, federal employees whose agency was shut down or not operating at full strength, taxpayers who were looking for the ability of a lender to verify the fact that their tax returns had in fact been filed and provided a certain thing, who were unable to make a loan. That is what I would call an operational risk. Now, I'm not quite sure we can convince Congress or the administration to do things to avoid that kind of an operational risk going forward, but it's an example of the kinds of things that happen, unintended events that could create an issue where we would have a systemic risk, which is namely the inability of lenders to provide credit to borrowers in need of it, who wanted to take advantage of it, and were unable to do so because of some event outside the normal course. One of the ways to deal with that, and one of the ways to deal with the operational risk, is to provide for, rather than mandating a particular provider, is to provide for diversity in terms of entities who would go through a very rigorous and intensive validation process, both as to, say, someone like the GSEs, but perhaps more importantly to the lenders themselves who would use it, and secondarily regulators of those particular lenders, is to provide for basically a neutral platform, a neutral situation, where anyone who has the expertise, anyone who has made the investment, anyone else or anyone who can provide and demonstrate for the benefit of the particular consumer, whether it's the lender or it's the GSE, that their scores or their model provides a level of certainty, a level of predictability, a level of insight necessary. The more of those entities we have at any one time, the less is the risk, operational risk, possible systemic risk to our economy going forward. What we have now, and I think it's unintentional, is we have a situation where lenders are not prepared to make the investment in validating a particular product. Because again, if you want to lend in a situation involving real estate, you want to have a conforming mortgage, you want your mortgage to be acceptable to Fannie and Freddie, the GSEs, and if the conforming requirements of Fannie and Freddie mandate a particular score, there's no value in terms of investing the money in providing other entities that would help you. Finally, let me just sort of finish the point there, which is any situation, and I think this is a lesson learned from 2008, where you have a single provider or a select group of providers providing a service that is necessary for the routine and normal functioning of our economy, you have a problem, a potential problem, an operational risk problem, systemic risk problem. Two quick examples. One was credit rating agencies. One of the difficulties, or one of the things coming out of the 2008 crisis and recognized by Congress and the administration, is that what you had in place was a monopoly enjoyed, albeit by a number of entities, which had the perverse effect of doing a couple of things. One is I would suggest, and this is my opinion, stifled competition, stifled innovation, which is critical in that area, and that once the product of those particular entities became suspect, as they did, the ability to rely on those entities was such that Congress basically outlawed their use by financial services entities. A pretty extreme result, but one that was probably, given the circumstances that Congress was looking at, was one they decided they needed to use. The last example I will use is LIBOR. I mean, a well-accepted, mandated index against which all kinds of credit and debt transactions were measured. We all know the story of LIBOR. We all know the situation that's resulted since then. But I think that's at one point, I can recall when I first sort of came to Washington, there were probably close to 20 different indices against which lenders measured the cost to the borrower or whatever else. LIBOR, there may be one or two others now, but there's been such a significant reduction that we're getting close to that point, again, as we saw with LIBOR, where you can't rely upon it, and the risk that is introduced into the decision-making is so critical. The last point I want to make, and I know we're getting a little bit long in time here, the last point I wanted to make relates to innovation. When it comes to competition, I would argue competition where you have more than one provider, the competition in a positive sense that comes from that situation, I would suggest results in innovation, improvements, in terms of the scores, who can be scored, how they might be scored, the kinds of trails that can be reviewed at and measured by credit score parties. And one of the positive things coming out of that sense of innovation is as you increase the numbers of scores you can provide, as you can increase the data that you can provide or you have access to in providing those particular scores, the greater the predictability becomes in terms of repayment. Again, as a regulator, we want lenders to make loans that are going to be repaid. One of the ways you can determine whether or not a loan is or is not a good loan is through the predictability of repayment. You price it accordingly, you review it, you provide capital charges to the particular entity based upon the loan quality. And I would suggest that we need more scores, we need different kinds of trails to measure those scores. And I'll give you one example. One of the non-legacy providers has scored 30 to 35 million additional consumers beyond what the legacy score entity had provided. Included in those 30 to 35 million consumers, additional scores, were 10 million scores of consumers who are considered prime. And I'd give you one example of a prime credit, and that would be a retired person. A retired person owns their own home, owns their own car, may or may not have a gasoline credit card, may or may not have a card to Macy's or some other retail outlet, but basically pays all of their bills on time, pays them with cash, does not have any credit trail currently. They are not scorable. Under, as innovations become more a part of it, as score entities look to add to the number of people who receive a score, you will pick up probably currently whatever 10 million. How many of those are retired people? My mother's one of those. She doesn't have a credit card. As the demographics change, as more of us get closer to 65 and beyond and retire, the issue will be an issue that we will have to be confronted with. So with that, I'm probably going to stop because I'm sure you have questions. Just that even look in your eye tells me that you do. So
you've provided us a rich amount of ideas here from your paper, and you've answered actually some of the questions that we've had. So I take away that there are two basic concerns, two themes going through your paper. One is the regulatory systemic risk, and the other one is the consumer's access to credit. On the first theme, how did a single company, did your research reveal how was it that a single company came to be the dominant provider of third-party credit scores?
From everything that I've done, everything that I've read, my impression is they were basically the first. They invested the time, the money, they had the ideas, they had the quants, the mathematicians, those that are needed to put together the black box. They identified the market, they identified the just unbelievable demand that would be coming out of other things happening in the market, including securitization of payment streams, mortgages, things like that, and the need to come up with a standardized index against which investors in those products might be able to measure. They continued along that line for some time, and my understanding is that the ability to put together a group like that requires significant capital, requires significant time, sweat energy, or, sweat equity, whatever else. And that there was a natural, aversion is not the right word, but there was a natural inclination for others not to invest. So you had almost by nature of them being the first and gaining market acceptance as they did to where they were at that point in time, you basically had others who weren't willing to take on particular risk and assume the responsibility. Subsequent to that, that was yesterday. Today, that's still the case. Although today we have a number of other providers out there who have done all of those things, who are looking at different innovations, different ways that they can provide a product that will serve the needs of the market.
And why have the regulators endorsed this dominant provider? And can you give me some examples that?
Yeah, it's funny. As a regulator, I can recall having testified many times and being asked questions by Congress, which is, what were you thinking? Why weren't you dealing with this? Why weren't you on top of this sooner than what you were? And the answer is two parts. One is, I suspect, given everything else that was going on, this particular issue, this particular focus was not number one on their hit parade. This is, at least from my perspective, this is an issue that's could become more prominent as we deal with some of the other problems that are out there. Having said that, the regulators have, over the course of the last probably 5 years, become more sensitive to the idea, first of all, of say what I would call a brand endorsement, of sort of picking a winner, picking one entity over the other, which as a regulator at any different levels, whether it's an agency or a financial services regulator, you really do want to avoid. But again, if we start with the proposition that there really was only one initially, yesterday, that was providing these kinds of services, at some point there's some affinity that develops, and some of it's natural not. But over the course of the last couple of years, all of the regulators have shied away from that. And I'll give you one example. The most recent QRM regulation, which was the comment period closed on October 30, qualified mortgage, there is a provision at the outset of that regulation which basically says by the 6 regulators who jointly issued the rule that they basically don't want to provide for a brand endorsement of a particular product, credit score provider, whatever else. They want to stay away from it. The downside of them endorsing something like that being what it is. It's a great statement that shows that they're alert, they're aware of the issue, they're trying to deal with it, they're trying to ensure competition, et cetera. Then on the other side of it, the QRM makes reference to the qualified mortgage, which was issued by CFPB back and becomes effective this January. And in the qualified mortgage regulation, there's a number of safe harbors, including one which basically says you are a qualified mortgage if you conform to the seller servicer guidelines of Fannie and Freddie. Go back to the seller servicer guidelines of Fannie and Freddie. We have a mandated score by the legacy provider. And whether the regulators, the 6 regulators, realized that's what they were accomplishing or not is not clear. But I am aware of numerous comment letters provided by parties across or letter writers across the spectrum who have pointed that out. Now, whether that will result in some change and sort of remove that brand endorsement, however indirectly, we'll have to see.
Now, are your observations focused only in the mortgage credit for mortgage, or is it third-party credit scores for all types of credit?
It's basically a concern across all types of credit. Although I think, as all of us here in this room realize, the bulk of credit, at least by dollar, is in the real estate area. Sure. So that's one of the reasons why we use the focus in the white paper to be on real estate, on the seller servicer guidelines. But third-party credit scores have become so routinized in terms of lenders making decisions to lend, not to lend. And as a regulator, we've encouraged that because, quite frankly, if you are starting to come up with indices against which, indices that are known to most, against which you make a decision, you remove sort of that intangible, which could result in violations of various regulations, anti-discrimination, things like that, age, and all of that. So third-party scores are there. There are providers of third-party scores, other providers in that space, whether we're talking student lending, automobile lending, okay, personal loans, small business lending, the kinds of things that really drive our economy, and for reasons that we've talked about earlier, are not quite as robust this time around. So there are others out there, but the real driver and the real determining factor, I believe, whether you're a real estate lender only, a mortgage lender, or you're a mortgage lender, automobile, et cetera, is the biggest part of my balance sheet are those mortgages. I want to be able to sell those to the GSEs. The GSE mandates a particular brand. So do I want to invest the time, money, effort, et cetera, to seek out others to provide a product and provide assistance in my lending decisions?
You mentioned diversity in the provision of third-party credit scores. Could you elaborate some more on why this is so critical?
Well, I think, again, the idea of having, I'll call it, and we talk about it in our paper, a too basic to fail. Everybody's aware of too big to fail. I mean, there are Some institutions, just given their business model, their inclusion in society, they really are. If they fail, we're in big trouble. Having a single provider of such a basic piece of information, and only a single provider, as I pointed out at the outset, the inability of that provider or the unwillingness of that provider to provide that information really is a real critical point. And the best way, and the only way I can think of to overcome that, is to set up a situation, the regulators and others to set up a situation where you have and you provide for at least the opportunity for others to participate and provide products in that space. So that's the sort of diversity that at least I'm talking about from a regulatory perspective. In terms of a credit scoring, in terms of a consumer perspective, the idea of diversity, I mean, not all of us own homes. Not all of us have credit. Not all of us, I mean, there's a significant portion of our community that have immigrants who do not bring with them a credit history. I mentioned retired people who, for a variety of reasons, have fallen out of some of these trails. The ability to score, the ability to at least recognize the various trails that all of us have, telephone, utility bills, payments of student loans and things like that, the ability to recognize that, which is in some ways a sort of a diverse set of trails from what normally happens, I think is critical to include the numbers and the types of persons who receive a score. And let me just make one quick point, and I may be anticipating, so again, slap me back. If you have a credit score, you don't get a loan. A credit score is a part of the process that allows you to get a loan. And I'll keep emphasizing that because, again, one of the lessons coming out of the 2008 crisis is people were receiving loans that should not have. And we had lenders who were lending to them. So when I talk about a credit score, I don't want to equate getting a credit score with getting a loan. You need a credit score to get a loan. You don't have a credit score, you don't get a loan, at least an affordable loan, which is so important for a lot of people who are just starting out, be they students or others. So,
You've made clear that what would happen if the dominant provider of the information was either unable or unwilling to provide the information. But just to be clear, could lenders still lend if that dominant provider were unable or unwilling to provide the information?
An interesting question, and I would suggest that lenders who are regulated, lenders who are subjected to a regulatory scheme, probably would not be able to. Lenders who are not similarly regulated, and I would talk about, again, the shadow banking sector, which is really distinguished by the fact that the kinds of regulatory oversight, controls, et cetera, that you would see if you were a bank or a thrift or some credit union, you don't see in that space. If you were the latter, namely you were a bank or a thrift or a credit union, your ability to lend would be problematic at best and probably would be impossible at the far end of it. A couple of things could happen. You could take that particular consumer who's requesting the loan and you could force them, for whatever their particular situation is, you could force them into another segment of our economy, the shadow banking sector, for instance, the high-cost lending sector of economy. And that's not something we want to have happen. So the failure or the inability, the unwillingness, whatever else, for that particular gatekeeper to be able to provide that index or that information could be catastrophic, not only to consumers, but also to the economy as a whole.
Okay, that's clear. The second theme of your paper involves the consumer access to mainstream credit. Tell us more about this and just credit scores in general.
Well, in going back to the original point, which is as credit has been basically an interim step in terms of the economy, and by that I mean if you've got a credit card, you have a credit card receipt, that receipt has probably been sliced and diced a number of times. It's gone into the secondary market. Same thing with a mortgage, student lending. We see Salome and others guaranteeing different kinds of securitization of loan receipts and others. If you pay your telephone bill, if you have a cell phone, that receipt has been securitized. All of those particular securitizations or financing transactions, going back to my point about a standardized index against which others can measure risk, etc. If in fact a consumer does not have a credit score, does not have the ability to demonstrate, and that's an imperfect word on my part in terms of demonstrate, it's his or her or their performance in dealing with these different streams. The ability to get affordable credit going forward, I won't say is impossible, but it's pretty darn close to. And I would also suggest we're seeing more and more in other areas where credit scores are being used for things other than lending decisions. Employment. If you don't have a score, are you employable? If you don't have a score, why don't you have a score? You know, those kinds of questions. And but the bottom line is, if you don't have that score, if you don't lead your life, if you're a renter, or you don't have any credit cards, you don't have any student loans, you worked your way through college or whatever else, the ability to get credit going forward, I won't say it's impossible, but it's very, very difficult. And it's not something that we should accept, again, because I keep going back to the same point, 70% of our economy is consumer spending. Consumers take credit to spend. We want a strong economy. We have to have strong credit. We have to have the ability of consumers to take advantage of that.
Okay. You're clarifying that that if you don't get a credit score, because it's extremely difficult to get credit. Now, getting a credit score doesn't guarantee a loan.
Absolutely not. I mean, and that's sort of one of the concerns we try to address in the paper, which is a credit score by itself. And I don't care if you have a number, if you have a letter, if you have something attached to it, does not guarantee that you'll get a loan. Does not guarantee that you'll qualify for credit of some kind. If you don't have it, you don't even get to submit the application. You don't even get to do the ask, which is, I want to borrow some money to go to school, start a small business, whatever else. So the credit scores by themselves don't guarantee a loan. They simply provide to the lender, for whatever type of loan product you're looking for, the ability to, I mean, and they're not the be-all, end-all. Let me point that out. As a regulator, you tell those that you regulate, especially lenders, the credit score is but a small part. Now, I'll give you a classic example. The seller servicer guidelines of the GSEs, 600 plus pages. There are probably 12 to 15 different, very discrete references to a particular credit score, legacy credit score provider. The other 600 plus pages are filled with all kinds of other things that if you want to sell your loan to Fannie Mae, you have to have complied with. You have to be able to furnish them with all of the other information, whether it's you've paid your taxes, you're employed, et cetera, et cetera. But the credit score really is the starting point, and the necessity to have a credit score to start that process. Again, you want to start a business, you don't have a credit score, it's pretty darn hard to do. You want to buy a home, you don't have a credit score, you're probably not going to be in a position where, at least in an affordable sense, you're going to be able to afford to own a home.
Okay. There's always a rule of unintended consequences, but in terms of competition and the provision of credit scores, by providing for more scoring or more people getting scores, could we be establishing a race to the bottom, much like we saw in the credit markets only a few years ago? There's always the possibility, because credit scores are only as good as the person who is reading them and using them to accomplish whatever particular project they've undertaken, whether it's the provision of a loan or otherwise. The ability to score more people, the ability to utilize more trails of economic activity by consumers, I would suggest by itself increases the likelihood of repayment, increases the quality of the information that the lenders are receiving. And the principal difference is the more history you have, the more data you have,
the more different kinds of data that represents appropriately activities of the consumer, the greater is the predictability. The easier, the better it is to measure the predicted performance of that borrower in terms of repayment of your loan. Now, as I mentioned earlier, we have lots of examples during the 2008 financial crisis and leading up to it where people who had credit scores were getting loans that they couldn't pay. It was clear on its face, whether they were liar loans, whether they were loans where people were counting on external events like, gosh, the community you're in, the appreciation of homes is 15%, 10%, whatever else. You can't afford it now, we'll give you a loan where you only pay so much. But in a year when the value of the home is that much higher, you can refinance at a lower rate that you can afford. People signed up, off they went. That was not a failure of the credit score. That was a failure to properly appreciate some of the risks otherwise that are there, which is if at the end of the day you're only making so much a month and your mortgage is something else a month, you should be able to pay those amounts and everything else. Not the fault of the credit scores, because the credit score properly measured activity, credit activity, repayment activity. It just didn't necessarily take into consideration, gee, I only make $31,000 a year, how can I afford a $500,000 mortgage? You could have a great credit score, but it still doesn't mean you can pay the mortgage.
And speaking of credit scoring, I think you alluded to this earlier, but was there room for innovation and inclusion in terms of credit scoring models?
Yes, yeah, absolutely. And I think we've seen it in some of the non-legacy providers. Some of the I'll call them trails that they have pursued and they've been able to score, I think provide a fuller picture. And I also might mention there's currently some legislation up on Capitol Hill where Congress, I think, recognizing the need for innovation, for greater scoring, a broader sense of scoring, basically has proposed some legislation which would require, to the extent that they don't interfere with states' rights and things like that, but that would require that consumers' telephone bills and other kinds of utility payments must be included in the overall, I'll call it the black box that one goes through to get that score. To take nothing away from Congress, the fact that they've recognized that there are many other ways to measure through the credit score performance of consumers, and in some cases atypical consumers, people who don't own a home, but people who rent a home, and there's more of those I think right now than, and even more so as we go along. The requirement or recognition that those people have the ability to repay loans, have the ability to satisfy certain obligations, we should find a way to measure and score those particular activities.
I see, John, that we're running out of time. If you were asked for the classic 2-minute elevator speech version of your paper, what would that be?
A couple of quick points. One is, I think the current situation where we do have a single provider of critical information, critical to the smooth functioning of our credit markets, in particular our real estate markets, the continued existence of one and only one, and the continued existence of a regime is too harsh a word, I would suggest in terms of a template that does not permit others to diversify the risk that having a single provider provide is something that we really have to be conscious of. There's going to be another crisis. There's going to be another financial event. We've seen that. I've been in Washington 30 plus years. I've seen at least 3 of these since I've been here. There's going to be another one, and I can't tell you what it's going to be about. But I think one of the lessons that we learned coming out of the 2008 crisis is that we have to predict better or identify earlier where we might see some of the potential roadblocks or potential hurdles over which we may not be able to get. If the single provider is either unwilling or is unable to provide, the information that's so critical to the provision of credit, what do? We go out and look for somebody else at that point and then subject the lenders and the GSEs and others to a significant validation process? That could take 3 to 6 months. What happens to the economy in the meantime? That's a risk that I think we need to recognize. And I think we're seeing more and more recognition. I go back to the 6 regulators and their statement in the qualified risk, the QRM regulation. And I think it is something that we have to be concerned about going forward. It's a simple fix. You simply remove the reference to a specific entity, and you provide for any entity that, and there are a number of definitions that would include the current entity plus the current dominant entity and others, and allow those who would want to use their scores, allow them the opportunity to use those and avoid that significant risk in the future.
Thanks,
All right,
John.
good. Thank you very much.
Thank you for joining us today. Now that the program is concluded, for those of you here in the room, please feel free to come up and direct your questions to John. And for those of you viewing us remotely, please feel free to email or reach out to John directly. His contact information is on the Venable website. Thank you.
Thank you.